All right, seller financing. We made it. Strategy number one. Let's dive in to the details of seller finance. So, summary first and foremost, seller financing is an agreement in real estate where the seller handles the mortgage process rather than a financial institution. Rather than obtaining a mortgage from a traditional bank, the buyer enters into a mortgage transaction with the seller. Now, my pro tip, easiest way to kind of think about seller financing style of transactions is that the buyer and the seller come together and all the terms are negotiable, which we're going to talk about. All of them are negotiable. So the down payment, the interest rate, the amortization, the purchase price, the call date, which is also called the balloon payment, all of those are negotiable. When you put them all together and agree on them, you are going to create a new payment. Okay, the payment that the buyer is going to pay to the seller. So in seller financing, two parties come together and make a new payment. I want you to remember that because we're going to revisit this down the road. So seller financing, new payment. Okay, so here's a quick example of how a seller financing transaction may go. So here we go. We have Jim, who is the buyer, and Jim's realtor, Deborah. We have Judy on the other side. Judy is the owner of this property, and she is selling it, and her realtor, Glenn. So the transaction looks like this: $400,000 sales price. And I'm going to stop right there. The home is listed for $400,000. So Jim, in a traditional style of acquisition, right, a traditional type of financing, Jim goes to the bank. The bank says, hey, Jim, if you want to buy this property and the purchase price is $400,000, we're going to need X amount of money down from you, right? Usually a percentage, 3, 5, 10, 15, 20. We're going to need a percentage down. And here's the interest rate we're offering you. And so Jim puts the money down, right, on the property, and then the mortgage company pays the rest of it to Judy, or pays off her note. Now, the important part to know about this is that Jim goes to the bank finances the purchase of the property. This is probably something you already know. But in seller financing, okay, for this example, this property is owned free and clear. So instead of Jim going to the bank to get a loan, Jim is going to the seller because the seller is going to finance the property. Okay, the seller is going to be the mortgage company or be the bank. So instead of Jim giving the 20% down payment to the bank, Jim is going to give Judy 20% down, $80,000. Okay, and Jim is going to have a 7% interest rate with a 30-year amortization and a 5-year term. So what all of these together are going to do is create a new payment, a principal interest payment. And so Jim, instead of paying principal and interest to the mortgage company, is now going to be paying principal and interest to Judy, the original homeowner, the seller. So that's one of the major differences, that the seller is actually financing the transaction, not a mortgage company. There's actually no mortgage company involved in this deal. Now, we have on the left, we have our title company, and on the right, we have our escrow company. Now, I would highly recommend doing every transaction, seller financing style transaction, with the title company. I personally would not do one without it. So the title company is still going to do everything they normally do with a traditional sale, right? They're going to be the third-party intermediary, the facilitator of the deal, exchange the funds, and Jim is actually buying the property. So Jim will own the property after they close. Now, what happens is title handles the closing, exchange of funds, new owner, etc. Now, the escrow and service company actually handles the servicing of the loan after closing. So this is where Jim pays his principal and interest payments to, and those principal and interest payments flow through the escrow company to Judy. Why? Because the escrow company is a third-party facilitator and servicer, and most importantly, keeping accurate accounting records of everything that happened in this transaction after it closed. Now, I would highly recommend using an escrow company. I personally would not do a seller finance transaction for myself or for somebody else without using a title company and an escrow company. But the escrow company is key. Title happens to close. Everything else regarding payments all happens through the servicing company. And we call that either we call that escrow company or service escrow or servicing company. So that's a quick high level about how a seller financing transaction would work with the buyer and the seller. And yes, the agents who are working this deal are definitely getting compensated. There is no reason why you would not be compensated in a seller financing style of transaction. It is just another way of helping a buyer and seller. The seller gets to sell, the buyer gets to buy. Okay, so let's dive into seller finance commonly asked questions. When we're talking about these types of transactions, here are the most common questions that I get. Now, are agents still compensated? We just went over that, but yes, agents are definitely still compensated. There is no reason why you are not paid a fee to represent the buyer or paid a fee to represent the seller. Do you have to use a title company? Technically speaking, no. However, I would highly, highly, highly recommend doing so, and I personally would not do a transaction without one. Do you have to use state forms? Technically speaking, no. However, this is a gray area. There is a very high likelihood that the E&O insurance that you have only will cover you if you're using your state's forms. So that is one thing you might want to look into is state forms and not state forms and what's covered and what's not by your E&O. Then also you got to make sure you adhere to state regulation and then EXP's regulation in that particular state. So to answer to answer your question, most MLSs or most forms that are used in a state, they have a seller financing addendum or they have seller financing style of documents that are already there. So that's what I would use. If those are not available, I would definitely talk to EXP and see what the best course forward is if you have a buyer or a seller who's looking to do a seller financing transaction. Okay, who creates the terms? Well, the terms are created by the buyer and the seller. Nobody necessarily creates them. Everything's negotiable and you have to agree on it. However, if you remember the conversation about the buyer and the seller, and Jim, who would typically go to the bank, is now going to Judy directly to finance the property. When you go to the bank tells you the terms. Because Judy is now the bank, I always recommend the buyer ask the seller, hey, if you're financing this transaction, what are the terms that you're looking for? That's always a great starting off point. Are inspections required? Technically speaking, no. However, I would highly, highly, highly suggest that inspections are performed. And if they are not, just make sure you put it in writing that you highly, highly, highly recommend them doing inspections, but they are declining. Is an appraisal required? No, because there is no bank, there is no appraisal required. However, the buyer or seller can request an appraisal is a part of the deal. And also they have to negotiate who's going to pay for it. So is appraisal required? No, technically, but can you do one? Absolutely. Who services the loan after it closes? We talked about that in our example. That's going to be your escrow and your servicing company. That is going to be who handles the payments after the closing, the principal interest payments that the buyer is paying to the seller. Does the property have to be owned free and clear? No, technically speaking, the property does not need to be owned free and clear. However, free and clear makes this a lot easier and simpler to understand. If there is debt on the property, there are certain parts about the debt. There's certain things you have to know because a deal might not make sense without knowing those particulars about the current debt that's in place. The other, which is for a conversation for another time, is that if there's debt on the property and the seller is selling to you on seller finance and not paying off that note, then you have to know is that there's a 99% chance that the seller is violating what's called a due on sale clause, which is a part of the mortgage agreement that they signed. Now, again, Is that good? Is that bad? What does that mean? That's a conversation for another time. But just knowing that the due on sale clause, technically speaking, is being violated. What is a call or balloon payment? Call date or balloon payment? So this is a great question that I get a lot. So the call date is if there's a certain period of time that the buyer has to pay off the total balance. So let's go back to Jim and Judy. Okay. So Jim buys Judy's home. Jim is making Judy principal and interest payments every month. They are going to set a predetermined time where at this point in time, Jim needs to pay off the total balance that he owes Judy. Kind of similar to paying off a mortgage, right? He's going to have a mortgage that Judy owns that he's going to need to pay off. Now, when he does that, there's three ways that he can pay off this note. Number one is if you have the cash sitting around, you can pay it off that way. Number two is you can refinance the property. And if you can't do either of those, you can put the property for sale and pay off the current mortgage with the net proceeds. So a call date could be anything. It's totally negotiable, but typically you'll see something from, any shortest 1 year, long, I'd consider maybe 10 to 15. But again, it's just going to depend on what the buyer and the seller agree to. How does the seller qualify the buyer? The technical answer is however they see fit. So the seller is able to request things from the buyer to prove that the buyer does have the financial capability to purchase the property and make the payments on time for the allotted amount of time. So things that would help a seller qualify a buyer potentially if they wanted, they could ask for bank statements. They could ask for tax returns. They can ask for an updated FICO report. They could ask for proof of funds for the down payment, like bank statements or in a bank account. Honestly, they could just have a conversation and they could call that's my qualification. It just depends, but the seller is going to usually determine what they need in order to feel comfortable to do a seller financing transaction. Now, before we get into the pros and cons of what's in it for the buyer, what's in it for the seller, just got to go over this quick legal disclaimer. Every situation is different. And before engaging in any type of creative financing style of transaction, it is important that you understand your state laws and eXp Realty's policies regarding creative financing and adhere to those policies and laws. For assistance, make sure you reach out to your state broker. Okay, cool. So seller financing, we got the buyer and we got the seller. Let's jump into the buyer. What are the pros for the buyer? Okay, so number one is no lending fees. So in a traditional mortgage or traditional purchase, there are going to be lending fees that the buyer has to pay. Because there's no bank, there's no lending fees. So that is a plus. All terms of the deal are negotiable. So this is kind of a pro for everybody, but the buyer has complete flexibility to try to make a deal with whatever terms the buyer and the seller can come up with and agree upon. No appraisal is technically required. You can close quickly because there's no bank. You don't need an appraisal. There's no approval. There's no underwriting. You can close pretty quick. So that's always a plus for a buyer. You have the ability to purchase if not able to purchase traditionally. So if you don't fit the traditional buy box of financing due to whatever circumstance that you're in, you or your client, you now have a way of purchasing a property without having to go the traditional qualification route. So that's a plus. That's an opportunity you now have. And sometimes there is no qualification needed. Now, I am not promoting this. I am not condoning it. I'm just saying there are times where the seller, outside of just making sure you have the down payment, does not ask for any other documentation to prove that you are credit worthy or you are a worthy borrower. So it's not necessarily a good thing or a bad thing, just saying it could end up being a pro for a buyer. Now, let's jump into the cons, okay? Need to pay off the loan at some point. That's what we call the call date or the balloon payment. This buyer, at some point in the future, there's a timer. They're going to have to pay off this note. So again, pay it off in cash. You can sell the property or you can refinance it, but you're going to have to pay it off at a certain point. So that could cause some stress. That could be inconvenient. It might be tough to do at that time, but that's something that the buyer is going to have to do per the agreement. And so that could potentially be a con. And sometimes the seller asks for large down payments or higher interest rates. And the reason why this happens sometimes is because theoretically, the seller is taking on a risk, right? They're not getting all of their money up front. They're not getting just to walk away from the property. They're financing you. So for the risk that they're taking, they may want more skin in the game, AKA more money down, right? So a lot less probability that you will walk away from the property if you have a lot of money tied up into it. And then a higher interest rate simply to account for the risk that they're taking on. Now, are those two things, do those happen every time with seller financing deals? No. However, it does happen. And if it does, that would be technically a con to the buyer. Okay, so let's jump into the pros and cons for the seller. First and foremost, all terms are negotiable: purchase price, down payment, interest rate, amortization, call date. It's all 100% negotiable, which is fun. Interest payments. So the seller is now receiving principal and interest. So they are actually collecting those interest payments along with their principal. Usually the bank is collecting that, but now the seller is. So that adds to the financial advantage of selling with creative finance and particularly with seller finance. The seller has recourse if the buyer doesn't perform. The seller can default. Well, not the seller's not going to default, but the buyer can default, and the seller can take the property back in what's called a traditional foreclosure process. So it can be lengthy with time. However, if the buyer stops making payments or is unable to make payments, the seller does have recourse to get the property back if the buyer does not perform. When you sell on seller finance, it is actually true passive income. Because remember, when Jim buys Judy's home, he's buying it. The title, it's all, he owns the property at that point, which means he's also responsible for taxes, insurance, landscaping, anything that's going on with that property, all the liability of it, that is now 100% on the buyer. The seller does no longer have that liability and is just simply collecting their principal interest payment every single month. So true passive income. And then last but not least, even from the seller side, it's a pro that you can close quickly. Okay, that's the pros. Let's get into the cons. The risk of foreclosure. The seller is taking on somewhat of a risk that this buyer may foreclose and the seller is going to have to take back the property, and whatever shape that property is in, you're kind of rolling the dice there. So risk of foreclosure, it can definitely be a con. Second is that you usually don't get all of your cash up front. Like, so if you own a property free and clear and somebody is buying it from you, typically they don't give you they don't give you 50% down. That's not typical. It happens, but it's not typical. So you're not going to get all of your equity out of the property, which could be a con depending on how much money you need to get from the sale. Loss of equity growth. So remember, we talked about when the buyer buys the property, right? They own it now. The seller no longer owns it, and the seller doesn't have to pay the taxes, the insurance, or take care of the property. That's all on the buyer. However, because the buyer owns it now, let's just say the property was $500,000, and then 1 year later, we have a crazy appreciation, and the property is now worth $600,000. Well, the seller does not capture that equity. The buyer does, because the buyer is technically the owner now. So if the property appreciates over time, the seller is not capitalizing on that equity growth. If there is a mortgage, so if there's debt on the property and you're the seller, technically speaking, that debt still stays in your name. And if you were going to qualify or try to buy another property, a lender is going to recognize that as a current liability on your debt to income ratio. So it could potentially negatively affect your debt to income ratio if you're trying to qualify for a purchase. So very important to know. So that's the buyer and seller finance pros and cons. Now, Last but not least, my pro tip when it comes to understanding the psychology and understanding why people do these types of transactions from a buyer and seller perspective, seller finance is typically used for gain. Now, when I say that, I'm saying typically used for gain because when a seller sells on seller finance, they get to become the bank. So typically they're going to agree on a price that they like, and they're also going to get principal and interest payments. So the seller is looking for more of a situation that they have financial advantages, which they do selling on seller finance because they get to, number one, negotiate all the terms to whatever everyone sees fit. And then on top of that, they now capitalize on the advantage and the additional income that comes with the interest that is included in the principal interest payment. Now, subject to, which we're going to dive into next, is typically used for pain. Again, typically used for pain, not always, but a lot of times in subject to transactions, there is some type of motivation that's driven by financial pain or circumstances that are not ideal. So if a seller is falling behind on payments, that would be financial pain. Subject to solves that pretty well, typically. So seller finance is used for gain. Subject to is used for pain. Easy way to understand kind of what are the more or less buy boxes of how these different strategies are used. So stay tuned. Next, we are jumping into subject to, and we're going to go a deep dive on everything about this creative finance strategy, subject to.